Okay, thank you for your patience. Welcome back. Okay, so we have talked on these major types of bookkeeping, the methods of bookkeeping, which is the single entry bookkeeping method and the double entry. We say for the single entry bookkeeping, it is quite straightforward. You don't need any accounting experience for you to use that. The problem is usually with the double entry bookkeeping, where you have to understand the nitty-gritty of debit and credit. In most cases, you need an experienced account staff, account clerk, or bookkeeper, or a qualified accountant to use the double entry bookkeeping. So, like we have said earlier, if you cannot afford the services of an account clerk or a bookkeeper, you are advised to use the single entry bookkeeping method. If you decide to maintain the financial records personally, and use the first one, which is straightforward. So let's consider accounting systems, what we refer to as accounting systems. Accounting systems are designed to collect, document, and report on financial transactions affecting business. Accounting systems are those systems that are put in place to help a company collect, document, and report on financial transactions affecting the business. Accounting systems are of two types, the manual accounting system and the computerized accounting system. For the manual accounting system, just like the name suggests, anything that is done manually, it means it is being processed by hand. So when a company deploys the manual accounting system, it therefore means that the company will have to process its accounting systems by hand. Meaning, if you have to record all your transactions by hand, your customer buys or you sell your products to a customer, you have to use your pen and paper to jot it on the analysis column, cash book. We have mentioned your heart notes, cover book, or any way, but you use hands in recording or keeping these transactions. It means you are maintaining the accounting systems manually. But if on the other hand, you rely on the use of computers in order for these informations to be recorded, it means you are using a computerized accounting system, meaning that your financial information is recorded by entering it into a computer. So for the computerized accounting systems, you are basically relying on the help of computer. And examples of the computerized accounting system could be when you use spreadsheets, Excel. You use Excel to maintain your financial information, your financial records. That is a computerized system of accounting. You also deploy accounting software such as Sage, Peachtree, QuickBooks, Tallies, and the rest, because these softwares thrive on computers, means you are using the computerized accounting systems. So for the computerized accounting systems, we have said you basically need to rely on the use of computer. Now, one thing you must know also is that even as we say computerized accounting system tend to be more efficient, because anything that is done with the help of computer will tend to be more accurate than when it is done mechanically, manually, by hand. Yes, computerized accounting system is more reliable, more efficient than the manual accounting system. But that does not exclude the computerized accounting system from containing errors. The computerized accounting system may also have some errors, and the errors in this case are man-made. They are man-made, just like what we refer to as GIGO, garbage in, garbage out. If an account clerk who is saddled with the responsibility of keying in this accounting information into the computer system makes mistake, maybe instead of keying in 20,000, he keyed in 2,000 naira, an error has occurred. And when the financial report is eventually generated, that financial report will be inaccurate, even though we have used computerized accounting system. So the point I'm trying to make here is that there is accounting system that is computerized may still have some error, and this error is only man-made. It is caused by man only. So let's take note of this, and we try to be thorough. We try to ensure that the information, the data we key into the computer systems are accurate and reliable and verified for us to have a less distorted or less inaccurate financial report or financial information. So there's also called GAAP, Generally Accepted Accounting Principles. GAAP, Generally Accepted Accounting Principles. All accountants use the same set of rules to prepare financial reports. All accountants use the same set of rules to prepare their accounts. The Financial Reporting Council of Nigeria, FRCN, is responsible for the issuance of these generally accepted accounting principles. It is the FRCN that issues these rules, which is then complied by all reporting accountants. The essence of this rule is to make the accountants to be objective as possible, to be unbiased. Let me give you an instance. You see, if there are no generally accepted accounting principles that accountants should follow, or those who prepare financial records should follow, you discover that the financial statement being prepared may be subject to manipulations. An accountant may prepare it in a manner that he wants to suit a particular user of the financial reports. Don't forget, we have various users of financial reports, ranging from the owners of the company, the investors, the lenders, the government, the employees, and all that. We'll look at that, the categories of users of financial information. So we'll be sure that the financial information prepared has been faithfully represented and it is devoid of errors. The accountant has to comply with the provisions of GAAP, Generally Accepted Accounting Principle. An average investor who does not want to pay taxes, who does not want to pay tax to the government, will probably try to influence the accountant to prepare the financial report such that the profit before tax is very little. And once profit before tax is very little, it will result to little or no tax payments to the government. So in order to forestall all of these, that's why the generally accepted accounting principle has to be followed rigorously by accountants while preparing the financial statement. Imagine also an employee, maybe your manager, whom you have placed at the helms of affairs to manage your business activities. The performance, the reward system of that manager is based on incentive. You have promised that performance bonuses will have to be paid to the manager depending on how much profit the manager is able to deliver. You can imagine what will happen even in your absence. The manager will want to influence the financial reports being produced to, at all costs, show enough profitability so that he or she can enjoy the reward system, the incentive that is tied to the profitability. So in order to avoid all of this window dressing and creative accounting that is bound to happen by accountants, that's why the Financial Reporting Council of Nigeria came up with this set of rules to be strictly adhered to by accountants while preparing the financial statement. So where financial reports, I want you to understand that the end product of bookkeeping activities, remember, emphasis here is on bookkeeping. The end product of the bookkeeping activity, having maintained all your bookkeeping, all your financial transaction, the end product of that bookkeeping activity is to help you, enable you prepare your financial reports. As the end product. Having maintained all your financial records, at least a qualified accountant should pick up the bookkeeping records you have maintained and produce your annual or financial report thereof. So summarize information about the financial status of a business is what we refer to as a financial report. And accounting is seen as a language of business because it is so fundamental to the communication of financial information. accounting is often called the language of business, because when we talk of accounting, we are referring to accounting for every naira and kobo that passes through a business. That's what we call it, the language of business. Now, there are basically two broad categories of accounting reports. Accounting report could be that which is prepared to address the needs of external users, or the one that is prepared to address the needs of internal users. So the two broad categories of accounting reports are financial accounts and management accounts. Financial account focuses on reporting information to external users, meaning if you, a business owner, prepares any account that will be issued out to external users, I'll tell us those that constitute external users. That financial report you have prepared because you want to serve or meet the needs of external users. That that accounting report you have prepared is referred to as financial accounts. So any account that will be served to external users is referred to as financial accounts. But any account that will be served to internal users, those who we know as the management teams, the owners of the business, that account is referred to as management account. So in most cases, how does financial account differ from management account? Financial account, because it is meant to be issued or presented to external users. In most cases, the financial accounts are usually being audited. You have external auditor express opinion on the financial reports before they're eventually sent out. So simply put, for the financial account that is presented to external users, it is usually being audited by an independent auditor. But for the management account, because this account will not be sent out, it is strictly within the confines of the business premises, the owners of the business premises, the employees, the management team. This account is usually unaudited. You don't get to audit the management account. So that is basically the difference between financial account and management account. So here are examples of external users. External users are individuals outside the business who have an interest in the business. So anybody who has an interest in your business, the person is considered to be an external user. Examples of external users are governments. Government in this case may be any of the government entities may require your financial report. Example in this case may be FIRS, Federal Inland Revenue Service. Being a government agent, FIRS may require that you submit your financial returns, your financial reports to them to assess you on taxes. If you are involved in insurance business, for instance, NICOM may also be a government entity that you have to submit your reports to. NICOM, National Insurance Commission. If you are involved in pension business in Nigeria, you may have to submit your accounts, your financial reports to National Pension Commission. If you are involved in rendering financial services, be it microfinance bank, mobile agents, commercial banks and all that, you may have to submit your financial statements to government approved agency, which in this case is Central Bank of Nigeria, because you render financial services. So these are government entities that may be interested in one way or the other in your financial report, in your accounting report. Another external user of your financial report will be general public. The general public may be interested in your financial report, especially if your stocks are listed on the floors of the Nigerian Stock Exchange. So in this case, it is only for the PLCs, the Dangote PLCs, Zenith Bank PLC, Julius Berger PLCs, and the rest. So because they have their shares trading on the floor of the Nigerian Stock Exchange, they have financial statement will have to be made available to the general public. No wonder why, if we go to Securities and Exchange Commission's website, we can easily access some of these financial or annual reports of these companies. Civil societies also will be interested in your financial reports, depending on your nature of your activities. You may have a civil society, any of these NGOs, non-governmental organizations, demand or want to see your financial report. Lenders also are examples of external users. Lenders in this case can mean those who have provided you with one form of funding or the other. Example, NISA Microfinance Bank. If you successfully get this loan from NISA Microfinance Bank, NISA Microfinance Bank becomes a lender to you. So therefore means NISA Microfinance Bank can at any point ask that you submit, you present your financial report or your accounting report to them. Now let's consider internal users. Internal users are individuals inside the business who are interested in the accounting report that you produce. Example of internal users are shareholders, owners of the business, just like you seated and listening to this lecture. When you eventually launch this business, you are the owner. You at some point ask for the financial reports to be prepared, and you scrutinize it, you analyze it to see how well you have performed over a period. Managers, those who are interested with the day-to-day administration and business running of the business, they also will be interested in the financial report, in the accounting report that is being generated. Employees, your workers who are on your payroll, they will also want to see what the financial report, accounting report looks like. So these are the categories of both external users and internal users of accounting reports. So here are primary accounting reports, the end product of your bookkeeping activities. Having maintained your financial records, is expected that you should be able to prepare balance sheet, income statement, and cash flow statements thereof. So if you maintain your books properly, a qualified accountant can generate any of these three accounting reports or all of these three accounting reports for you at your demand. So number one is a balance sheet, which can be generated from your bookkeeping activities. Balance sheet is a statement that is prepared to show what belongs to a business and what the business owes outsiders. So a balance sheet shows what belongs to you as a business owner and what you owe outsiders. So what belongs to the business is referred to as assets. I'll show us a sample, a format of a balance sheet. So what belongs to your business is assets, while what you owe outsiders is liabilities. And what is being contributed by owners of the company is referred to as equity. So in any case, there's what we call balance sheet equation. This balance sheet equation states that equity and liability put together must equal the total value of assets. In other words, if you have a total assets, remember we said assets are all resources belonging to your business. If you have a total asset, I don't know the nature of your business. Take, for instance, you're involved in farming activity, you have a tractor, you have your hose, you have your cutlasses, you have your farming implements and all that. You have your office, your tables and furniture, you have your motor vehicle, maybe your truck, your van that helps you convey some of your farm produce. So all of these are your assets because you use them basically for revenue generation. They are your assets. So if this asset we have mentioned is put at 10 million, for instance, it's expected that your equity and your liability, when we aggregate them, when we sum them up, must give us the 10 million, the same value of your assets. It must give the 10 million. Take, for instance, you have a tractor, you have farm implements, you have office furniture and equipment, you have generators and all that. That is worth 10 million. We are saying, how was this asset financed? It would have been financed through either equity, don't forget we said the fund contribution by you, the shareholder, and every other equity participant. If you, the owner, bring 6 million to finance these assets. Then the balance of 4 million, which is left, probably you have borrowed it or taken it as a loan from NISA Microfinance Bank. So you see the amount you have contributed, which is equity, plus the one you have borrowed from NISA Microfinance Bank or any lender put together will give you the total value of your assets in the company. So that's what we mean by balance sheet equation. So at any given point in time, you can find the missing link. For instance, if you are told to find the value of your equity, you have a total asset that is worth 10 million. You are told that the amount you have borrowed is 4 million. Definitely, you don't need anybody to tell us that if we minus the 4 million from the total value of the asset of 10 million, the balance is 6 million. And that 6 million will represent equity, the amount that has been contributed by the owners of the business. That's for balance sheet. Now, income statement. Income statement is prepared to show in terms of profitability how much a company has made. So income statement is prepared to show how much profitability a company has made. So when you prepare income statement, you're basically looking at to see either profit or loss for a particular period. And these accounts, both the balance sheet, income statement, cash flow statement, they are usually prepared annually. That's every 12 months you prepare them. And most companies have chosen to adopt the January to December accounting period, 12-month accounting period, to align it with the government accounting date, what we call government accounting date. So income statement will tell you if you are making profit or loss. That's why it's sometimes called statement of profit or loss, meaning if you are not making profits, you are either making losses. That's why it's called income statement or statement of profit or loss. So how is it prepared? You aggregate all your sales, then you minus your expenses, it leaves you with profits. But on the other hand, if your total expenditures you have incurred exceeds your sales, your revenue, it therefore means you have sustained losses for the period. So in a few slides from now, I'll show us a sample, a format of the balance sheet and income statement. And the third one is cash flow statement. The cash flow statement is prepared to show the liquidity position of a company. When a company prepares its cash flow statement, the company basically wants to see how liquid it is. Liquidity is defined as ability of a company to meet its short-term debts when they fall due. I mean, how much do you have in the bank account? That's what we mean by liquidity. So if you want to check how liquid the company is, does your company have enough resources at its disposal to dip hands into and pay suppliers, creditors when they come, knocking and making demands for their money? The swiftness, the ability to settle it when it's due, means that a company is highly liquid. So that's why we prepare cash flow statement, to see how liquid a company is. And when we prepare cash flow, we basically aggregate all the inflows, all the total cash generation by a company, then we minus all the cash outflows by the same company. It will leave us with either surplus or deficit. Surplus connotes that you have collected more money than you have spent during the year. But if you have spent more than what you have collected, it means you have a deficit in this case. So don't forget, liquidity is quite different from profitability. In most cases, you see a company that records high profitability when they prepare income statement. A company is adjudged to be making profit. See huge profit after taxes. But when you prepare the cash flow, you discover that there is nothing, little or nothing left in the bank account for the company to dip hands into and take care of its needs. So in most cases, when we place, when we have to choose between profitability or liquidity, in most cases, we prefer liquidity. We want to see the company being liquid, highly liquid, than being profitable. So we have to take note of this. So here is a sample of a balance sheet. Here's a sample of a balance sheet. Liability and equity put together will give us assets. liability and equity joined together will give us the value of asset. Don't forget, I told us before that when we add liability and equity, it must give us the value of an asset. Income statement is prepared by aggregating all the revenue minus your expenses. It leaves you with either profit or loss. It is loss if your expenses are more than your revenue. So here's a sample, a format of a balance sheet. The format of a balance sheet. When you look at this, you see on the left-hand side, we have assets. On the right-hand side, we have liabilities and equity. Assets. Assets are resources belonging to a company, which the company uses to generate what we call future economic benefits. So any item, any resources within the control of a company, which the company uses to generate revenue, is what we refer to as assets. So assets are further sub-classified into two: current assets and non-current assets. An asset is said to be current if those items belonging to the company can be converted to cash within 12 months after its classification as current assets. So between the period when these items come into the financial statement as current assets, it's expected that they don't last up to 12 months for these account balances to have been received by the company. So here are examples of current assets. We have cash and cash equivalents, the cash at hand, cash at bank, and all that. Those are what we refer to as cash and cash equivalent. Accounts receivables. Accounts receivables are trade debtors, those customers who are owing a company. Imagine having sold on credit. You have sold your item on credit. So that amount you're expecting to collect from your customer, we call it account receivables. Some people call them debtors. So because you are being owed by these customers, and these customers are expected to settle these account balances within the next 12 months, that's why we categorize it under current assets. Inventory, sometimes referred to as stocks. Any item that is held by a company for the purpose of resale. When you have an item you are holding in your company and the intention of holding that item is to sell it, we call it inventory or stock. So any inventory or stock that is held by a company is expected to be converted to cash within the next 12 months. So simply put, when you put an inventory in your balance sheet, it's expected that within the next 12 months, that inventory would have been sold and translated into cash to the company. Prepaid expenses, payment in advances. Payment in advance is also an asset. A company may decide to pay in advance. Sometimes landlords may require 2 years' rent to be paid. So when a company pays for a rent in advance for a period it has not utilized, we classify it as prepaid expenses or payments in advance. Then investments. Any investment that you have that has maturity within the next 12 months will come under current assets. You may decide to have a fixed deposit that is due to mature within the next 12 months. It is an investment and it will come under current asset. You may have government bonds, treasury bills, and all that. They are investments that have maturity within 12 months. Now, after the current assets, the other type of assets are non-current assets. Non-current assets is the opposite of the current assets, in the sense that non-current assets are those items or resources belonging to a company which cannot easily be converted to cash within 12 months. So a good example of non-current asset would be what we call property, plant, and equipment. What constitutes property, plant, and equipment? If you have lands and building will come under property, plant, and equipment. That's a non-current asset, because when you have lands and building which you use for revenue generation, the land and building is not anytime expected to be converted to cash. It cannot be converted to cash within 12 months. It's expected naturally to live above 12 months, above 1 year. That's why it's categorized under non-current assets. You have motor vehicle. When you have motor vehicle, the motor vehicle is expected to last over 1 year. That's why it comes under the non-current assets. You have office equipment, generating sets, plant and machineries and all that. These are items of property, plant and equipment, and they're expected to last over one accounting year. They will come under the non-current assets. Then we also have intangible assets, still under the non-current assets. Intangible assets. Intangible assets are identifiable non-monetary items without physical substance. Identifiable non-monetary items without physical substance. If you have any item that you cannot see, feel, or touch it, but that item is used in generating revenue, income for the business, that item is referred to as intangible assets. A good example of intangible asset which we cannot see, feel, or touch is goodwill or licenses. Imagine having a license. You have a license that gives you the right to fish from a particular river. That license, you cannot see it, you cannot feel it, you cannot touch it, but that license helps you in generating future economic benefit, in generating income for the business. That's why it's categorized under intangible assets and under the non-current assets. Then we move on to the right section, which is liabilities and equities. Liabilities are amounts owed to third parties. Any amount you collect from third parties, they will come as liabilities. So liabilities are also categorized into two broad categories: current liabilities and non-current liabilities. For the current liabilities, the amount you in the next 12 months. That's why it's called current liability. When you owe either your supplier, your employees, you expect that that amount will be settled within the next 12 months. It will be classified as current liability. Example is accounts payables. Maybe perhaps you have bought goods on credit from your customers. It is called accounts payable. Note payable, maybe you have loans that you have to settle or pay back within the next 12 months. It is treated as current liability. You have accrued expenses, you have enjoyed goods or services, and you are yet to pay for it. It will be treated as current liabilities. You have deferred revenue. Perhaps you have received income from your client, but you have not discharged the performance obligation attached to you earning that income. Maybe a customer has paid you for supplies and you have not paid the supplies. It is the liability. It is indebtedness to you, and it comes under current liabilities. Now, the non-current liabilities are indebtedness you owe third parties which cannot be settled within 12 months, meaning the indebtedness can linger, can last over 1 year. A good example, long-term debt. You may have long-term debt. A good example of long-term debt could be when you successfully secure this loan from Nisal Microfinance Bank, because you are not expected to pay back the loan within the next 12 months, it will be categorized as non-current liabilities. And the other portion, the last portion, is the shareholders' equity fund. Shareholders' equity fund. These are balances belonging to owners of the business. Those we refer to as equity participants, the investors. So under the shareholders' equity fund, you will have stuff like ordinary share capital, all the share capitals that have been subscribed, issued and subscribed by the shareholders. All the retained earning, accumulated profit or losses over the period that the business has been in existence, all of them will come under the shareholders' equity fund. So, ladies and gentlemen, one thing I want you to observe here, when you look at the total assets on the left-hand side and the total equities and liabilities on the right-hand side, you will notice that the two balances, the two figures are balanced. So balance sheets, when correctly prepared, the debits and the credit is expected to agree, just like we can see on this screen. $472,100 is the same value with the credit. If everything has been correctly done, your balance sheet is expected to balance, to agree. Then this is income statement, sample of income statements. The income statement, you aggregate all the sales and you aggregate all the expenses. Then you minus the expenses from the sales, leaving you with profit or loss. From there, you pay taxes to the appropriate government authority. One thing I want you to observe here, under the income, the sales, you can see that the sales earning activities have been categorized here. You will see client service revenue, book sales, professional consultation. These are activities that earned this company sales for the period. Likewise, when you prepare your account, it's expected that all your sales or income earning activities should be clearly stated. Imagine being involved in various farming activities. You have various operating segments. You have cultivated yam. You have cultivated cowpea, which is beans. You have cultivated maize. It's expected that when you prepare your income statement, you should show the income from each of these three operating segments. Income from cowpea, that is beans, income from yam, income from maize. This will help users of financial information to analyze and have in-depth knowledge of the financial statements you have presented to them. Also, I want you to notice that even as the current year is the 2004, based on what we have on the screen, the current year figure is 2004. That's the most recent. That's the year we are reporting, 2004. But if you notice, you will see that last year figure, referred to as comparative, has been presented. So when we prepare income statements, it's expected that the comparative figures for the prior year will have to be placed beside the current year. This is done in a bid to allow users of financial information to make adequate predictive decision, to take adequate predictive decision. Anybody who looks at this financial statement, this income statement, will want to see what was revenue this year and what was revenue last year. Has there been an improvement in revenue activities from last year to this year? The person will also want to inquire, what is profit this year and what was profit last year? Has profit grown from what it was last year to what it is this year? So when you prepare your income statement, it's expected that you include the comparative figure beside it. That's the last year figure has to be placed beside it. So here are components of accounts. For every account that is prepared, you must have, or you should have, these components. They are assets, liability, equity, revenue, and expenses. 5 major components of accounts. So these components of accounts are used in preparing both the balance sheet, the income statements, and the cash flows. Take note, the first 3 of these components, which is asset, liability, and equity, the first 3 are used for the preparation of balance sheets. We use the asset, liability, and equity, the first 3, in preparing the balance sheet. While the last 2, which is revenue and expenses, are used for preparing income statement, what we refer to as statement of profit or loss account. So no matter the size of the company, no matter what the company is into, any of their transactions will fall into these 5 categories. Take, for instance, a company pays salaries to its workers. Salaries definitely will come under expenses, which is the 5th item on this component list. A company procures motor vehicle for its operation. Motor vehicle will fall under the 1st component, which is assets. A company takes a loan from NISA Microfinance Bank. The loan will fall under the liability, which is the 2nd component here. So no matter the activity, no matter the financial transaction, it will definitely be categorized under any of these 5 components. So accounting is the process of recording business activities that make changes to accounts. When we record business activities such that our account balances will have to change, either go up or go down, increase or reduce, as the case may be. It means we have what? We have accounted for the transactions. Examples of the accounting transactions that will cause our balances to either go up or down will be the sales of products. When the company sells a product, the balances will either go up or down. When the company renders services, thereby earning revenue, the revenue will go up. When a company buys products or services, the purchases will go up, so on and so forth. So when accounting transactions happen, one account goes up and another account may invariably go down. You have to take note of that. Double entry. I don't want to bother us with double entry. Remember, we said there are two ways of maintaining our financial records, two ways of bookkeeping. We have the single entry bookkeeping method and the double entry bookkeeping method. And we said that those who do not have accounting knowledge can use the single entry bookkeeping method, where we talked about recording all financial transactions either on a hard notebook, either on analysis column cash book, which you can buy or procure from any bookshop or store, or recording payments on check stubs and all that. So these are simplified ways of recording the transaction. So my understanding is that in classes like this, most people may not have accounting knowledge, and as such, we can use the single entry bookkeeping method. So the double entry, if you have an accounting background, you understand what it means for a particular account to be debited and the other to be credited, then you can use the double entry. But if you do not, I strongly advise that you stick to the single entry bookkeeping method, which is quite simple and straightforward. So here we say some accounts are debited. When an account is debited, some balances go up while others come down. I don't want to bore you with this, because emphasis here is on bookkeeping and financial planning. So financial statement preparation is out of it, but this has been included such that when you want to maintain this account yourself, and you want to even go as far as preparing the financial reports independently without consulting a qualified accountant or auditor, you can make reference to this material to see how these accounts are better prepared. So, ladies, I can only see gentlemen. I can only see gentlemen. So, gentlemen, on these notes, I will have to stop, and the class will come to an end now, while we take your questions and observations. If you have any question, any observation, you can indicate by a show of hands. You can indicate by a show of hands, or you go and go to the chat box and click on the raise hand icon so that we can unmute you and allow you talk to us. Any question, any observation? If there is none, then we can quickly proceed to our post-lecture quiz. Expected to take us just 5 minutes. Are you talking to us, Godwin?
Yes.
Okay, we are listening.
Okay. I wanted to confirm, which method of accounting would you advise for a starter?
Okay. For a starter who does not have accounting background or knowledge, you can use the single entry method of bookkeeping, which we have said it is quite straightforward and simple, very easy to use. Very easy to use. But even though it has its own shortcoming, any external auditor or professional accountant you will bring in later to draw up your accounting report from the bookkeeping activity you have maintained, the person will know how to navigate those challenges. But usually the double entry bookkeeping is the most preferred. Problem is that it can be sometimes cumbersome or difficult, because sometimes when you ask even those who have studied accounting at the undergraduate level, when you ask them to journalize a particular transaction, most times they get confused which account is to be debited and which one is to be credited. So now I want you to imagine somebody who does not even have accounting knowledge, how the person will cope. So I would strongly advise that you use the single entry bookkeeping method as a startup, as a starter.
Okay, that's okay.
Any more comments, observation, questions? Okay. In the absence of any, the lecture quiz, post-lecture quiz, has it been posted? Okay. So we posted now. So it's expected that exactly by 12:17, you should have returned your answers. Has been posted. Lecture quiz has been posted. So we expect you to make attempts, submit your answers between now and in the next 4 minutes. So exactly 2:17. Exactly 2:17 by 2:17, class will come to an end. So love to see your faces even as you make attempts.
Daddy,
Yes.
I want to prove.
Your faces Okay, we noticed that you are yet to send in your answers. So you have between now and the next 24 hours to do so. Please, if you have not sent in your answers, I strongly encourage you to do so, please. So on this note, we want to appreciate you for your time and your audience. And we'll meet same time tomorrow. Same time tomorrow, yes, tomorrow morning by 10. Continue the training session of day 3. So I understand we are busy people. We need to go and attend to other things now. So on this note, gentlemen, the class will come to an end. We want to see you tomorrow and try to be punctual enough tomorrow so that we can also finish in good time.